Olá, o meu nome é Miguel Rego e estou aqui da parte da FundsPeople para dar as boas-vindas ao podcast com o tema Investimento de Value na atual conjuntura. Nesta conversa contamos com Nuno Pereira, CEO da boutique de investimento nacional 60 Degrees, que são conhecidos pela abordagem flexível e diversificada em investimento, e Daniel Nicholas, Client Portfolio Manager na Ares Associates, uma das boutiques da Natixis Investment Managers com uma marcada filosofia de investimento de value. A conversa será em inglês e esperamos que se revele interessante para todos os assistentes. And now we'll hear from Nuno and Daniel. Nuno, go forward.
Hi, Miguel. Thank you for your introduction. Hi, Danny. Nice to meet you. So, Miguel sent us this challenge, and we are happy to say that we were investing in value since the beginning of the year. Value has had quite an outperformance to growth since the beginning of the year, but we are a little bit concerned because we are very traditional in analyzing companies, DCF, discount models, etc. And for us, value is been challenging and a bit difficult to find because nowadays we feel market is a bit split. People divide half the index is growth, half the index is value. How do you see that this new definition of value, or people that define themselves as value and they buy growth at a reasonable price, the new GARP? How do you see this market trend and the evolution of value on your side?
Well, pleased to meet you, Nuno, and congrats on making that call. It has been a nice move over the last 9 months or so with value finally outperforming growth. You know, typically when you look at the historical relationship, it's very cyclical. It tends to be every 3 years, value will outperform, then growth will outperform. And that's been a very nice relationship, but it's been 13 years since value has consistently outperformed. So there's something different going on. And to get to your question, really, we believe the same definition of value is still applicable today. So in 1934, value was defined by Benjamin Graham as margin of safety. Today, we still define it as margin of safety as well. So what does that mean? Well, you need to figure out what a business is worth and then only buy it at a discount to what it's worth. That's value investing. What has changed through time, though, is how you define margin of safety. How do you figure that out? So originally, back in the 30s, 40s, 50s, the economy was very manufacturing oriented. So you could measure what the property, plant, and equipment of a business was. And if you could do that, that would be about 80% of the value of a business. If you knew those assets, then you just buy those stocks at a discount to those assets, and you could patiently wait, and that margin of safety would close. Fast forward to today, and the economy has moved to a service economy. 80% or more of the value of a business is not found on the balance sheet in property, plant, and equipment. It's people. It's technology, it's patents, it's R&D. Those are things that are harder to measure. And so value investing and investors really need to have more of a deep due diligence to be able to measure those that margin of safety. And you can't just use a rule of thumb like PE or price to book. And to your point, you know, growth and value companies tend to be separated by that statistic, which we don't think is that applicable.
Yeah. What we see is that there's also a big chunk of the value of the companies, because interest rates are so low, that is attributable to the perpetuity, that mystic value. And for us, that is a big risk because, as you said, technology, people, etc., are the biggest value today in most companies. And that can change really fast, and investors that are outside of the day-to-day of the companies don't perceive that change that fast. In that sense, we are a bit afraid of the value traps, so to say. And the typical example is the banking sector. That is, in our view, it's too big and too heavy to deal with this new speed of technology and information, etc. And in regulation are really heavy on them in order to be efficient and improve in a fast way. So how do you see, in terms of sectors, maybe some tips for people who are listening, how to see if a sector as a whole has some potential, or is just an old-fashioned business model and has high liability and higher risks for investors?
Yeah, you're spot on. Really, what we have found over time is that it's not enough to own a company that's statistically cheap, because it might be a melting ice cube, they call it. So it's a value trap over time where it doesn't have future growth coming forward. So we require businesses to have growth, and we need them to grow per share value over time. We just don't want to pay a high price for that. And so combining both growth, which we define as quality, and low price is how we invest in value to try to avoid those value traps. And in preparation for this, I looked at an Investopedia, and it actually defined value traps as statistically cheap companies for a very long time period that are not growing going forward. And it gave 3 examples. And ironically, one of the 3 examples was European financials. And we have a lot of exposure to European financials. So it's great to have this opportunity to kind of make the case there. And as we look at the last 10 years, European markets have really run into a lot of macro headwinds. So you've had the sovereign debt crisis in the early part of the decade. Then you had Brexit, Italian elections, you name it. There's been a lot of macro uncertainty. That's led to lower than expected growth in the European continent. And lastly, the valuations have stayed quite low there. And so it's kind of the typical definition of a value trap. We need to basically take a blank slate analysis with our ideas and look to see if there's growth going forward. And we do believe financials have growth going forward. They have about a 4% dividend yield, very positive. They are growing their book value per share 4%. That means their earnings have actually been growing, even though we've had persistently low interest rates. And we've had a huge increase in capital build to make them less risky. In the future here, we actually think the regulators will allow them to release capital through higher dividends and more buybacks. So we think we can get to our hurdle rates in these financials without even worrying about the macro economy. They have kind of this built-in engines for per share value growth going forward, which we think basically strikes it from the definition of being a value trap.
That's very interesting. We also look at that industry, but I must say we are really not afraid, but puzzled with this fusion between technology, telecommunications. These sectors are trying to attack the banking industry and take big chunks of the margin part of the business and not the liability part of the business. And we feel this is a big a menace to the players that used to or still dominate this industry. And so I think it will be very interesting to see, as you said, these macro headwinds still coming, interest rates that may have bottomed, and the industry could survive this big period of problems, and how they will face this heavy competition from technology companies and telecommunication companies that are going to grab parts of their business. I think banks are changing to become somehow also technology companies.
Absolutely. I'm glad you bring it up. If you don't mind, I'll just kind of jump in on that, because we actually think that big multinational financials are better prepared to withstand this technological obsolescence and risk. If we just look at how we exchange money right now, we used to go to a bank teller. It was very expensive to have these branches. Many of the banks are reducing the number of their branches. That used to cost over $1 or so per transaction. Then we moved to ATMs, where you could go get your money out of the ATM, and that was less than 10 cents a transaction. Now, when you invest in a digital platform, you can transact on your phone. That's less than 1 penny per transaction. So we think it's very rational for the banks to be investing in digital technologies, because we think it widens their moat. Moat is one of those value terms that you hear quite a bit that will continue to distance them from the competitors. They need to have a lot of money to invest in these digital platforms. They've been able to do that, and they've also been able to cut costs. And that's why you still see them growing, even though interest rates have stayed quite low.
And I think one of the appeals of investing in value, especially for these players that know well the sectors because they are part of the sectors, is M&A, because if the companies are cheap and the people within the sector have capital and have money to buy each other, I think that could be a good driver of this value plays. So this is one of the drivers we are still hoping to manifest themselves in this type of market, and I think this will be one of the drivers of the future outperform of growth versus value versus growth in the near term. But going into that, how do you think that of the persistence of this outperformance? Because what we feel, and doing some statistical analysis, we see that while interest rates are going up, so cash is more precious today, so value companies tend to outperform growth. But it's not when the interest rates plateau, they start. That sentiment starts to penetrate the market, and things stop moving in that direction. The value stops outperforming growth. So, do you have an expectation how inflation and the rates hikes could and up to where could impact value? So, do you have an expectation on going forward? Where are rates going to stop, and which kind of movement can value have towards our growth?
Sure. Yeah, I think you're spot on that there's been 100% correlation essentially with the slope of the yield curve and the value factor since the global financial crisis. As interest rates have been going down, it's pressured value stocks. As interest rates have started to go up and the yield curve has steepened, the value factor has improved there. That has to do with expectations for future growth and future inflation, which leads to interest rates rising over time. That's been the catalyst here, and we needed to see that to get value to start to outperform. The next leg of that catalyst then will be earnings expectations, growth expectations. Bank of America just published a study that showed that growth expectations for value companies are higher than growth companies right now. And so we're going to need to continue to see value companies have that next leg of growth for people to want to have that growth. Otherwise, you're going to just stay in that part of the market that you mentioned, that the Alphabets, the Googles, the Alibabas of the world. So growth expectations are crucial. When you have inflation, value companies tend to not be able to pass through price increases unless you have inflation. And so it's been actually very good for these value companies to improve their growth expectations when you see a little bit of inflation. Not too much, just a little. Where do we see rates going to? We're at about a 1.6% US Treasury right now. The Fed is looking for a 2% 10-year or 5 to 10-year expectation for inflation. So you have a little more room for interest rates to rise. If you look at a corporate bond, then you should get a credit premium and liquidity premium on top of the US Treasury. So we think rates on a 10-year could go to 3% or something like that. So even double from here. We don't know exactly when that will be, but that's kind of where, as we normalize and growth improves, and we get away from this extraordinary support from the monetary and fiscal side of things, we think that that's where it'll end up. And that's an environment where value companies continue to do very well. Lastly, I just mentioned, what is that price that you're paying for those expectations? Value companies tend to get a lower price earnings multiple than growth. Mm-hmm. How much lower? Well, usually you would pay 2.7 to 3 times higher for a tech company. So let's just say 30 times for tech, 10 times for value, just to make it easy. Right now, we're trading at about 7 times higher for tech versus value. So we're still paying too much for that seen growth that people feel very comfortable with. That's why we think there's still some more room to go with value to normalize.
Right. And so I think your reading of the market is the same as ours, that this movement just started, and it has this rotation, or in terms of if there is some persistence in the outperformance of values towards growth, it's just starting. And one of the drivers of this last leg in growth, we see it in the markets, is retail investors. So they come and they buy the names they are comfortable with, the things they own, like an iPhone. Okay, I buy Apple, things like that. Do you think they will diversify? Is there I don't know, a Reddit forum for value companies, and the people will start to feel the price tag they are paying? So I don't know. Nobody wants to invest. It's not sexy to invest in paper companies, but it's a business that is here. It's not growing. It's associated with some pollution or something like that. But at least in Europe, there's a big effort to change plastic things to paper things. So maybe there's an extra leg here for this kind of business. Does the retail investor, at least in the US, from your perspective, does the retail investors have the ability to adapt fast enough and go to this trend of value versus growth, or are they persistently going after the bitcoins of the market, after the names that are in the internet sites that they see?
Yeah, I've been here since 2012, and this is the first time I've ever had incoming requests for U.S. equity value. And it's coming from the retail channel. So I'm actually positively surprised that retail is onto this story a little bit earlier than normal. But, you know, in general, Morningstar does studies like this. The published returns of our returns from our funds and strategies tends to be about 2% higher than what the retail investor gets. Unfortunately, they go to the hot managers and buy trends and themes too late at high prices, and they sell at the lows. And so they hurt their total returns. And that probably will continue. That's part of our edge, unfortunately, where, you know, some people buy stocks for different reasons. But you look at a auto industry, which is typical value. General Motors is a company that we own. We have to come up with intrinsic value, which we model out the next 5 years, and then we come up with that terminal value that you mentioned, where so much of that value of the business is. But we also have to look at not only their current offerings of trucks and SUVs and sedans, but what are the future technologies that they've had? And they've invested in autonomous driving. There's a company called Cruise that they own. They invested $1 billion, and 3 short years later, it turned into $25 billion. That's 25% of the value of their market cap. And all of a sudden now, because they've turned to a zero emission future, and they're going to be producing many more electric vehicles, the market likes this story, and the millennials are starting to invest in General Motors. It seemed like dead money for many years. Now it's kind of hip. And so, you know, we need our managers, our CEOs to basically come up with what are the future growth prospects for our business? How can we keep this business sustainable? And that's what we rely on the management teams to do.
And maybe they can do a very, that's also a marketing job for them, right? So to get themes like the ESG trend now, and to adapt their mottos and their missions of the companies to take some part of this community sense that everybody is developing around the world. And so how do you feel that this seems like ESG, for instance? Do they accelerate these trends? They impact these trends in somehow? Are typical value managers suffering because they don't identify themselves as ESG and they are trying to fight it? How do you see these themes developing?
It's quite interesting, because if you're an active manager and you own a lot of stock like we do, we tend to own about 4% of the float of a business. We're able to meet with the CEOs, the CFO, the business managers, the chairman of the board, and that enables us great access to influence their business. We do that in a private manner, but what we require them to do is, how are you going to grow per share value for shareholders over time, and take into account stakeholders as well. ESG is just a natural extension of what we've always done. We just didn't really kind of call it ESG, but governance, we feel very good about. The E and the S, we've brought in outside influences and data to help us with those decisions. And really what we need to do is price in any material risk or any material opportunity right into the free cash flows. And then you price that in by discounting back those cash flows. Riskier businesses get higher discount rates. Companies that own coal assets, when you look out 10 years, you're going to see declining production of that. You need to price that in. And so that's all just kind of a natural way for us to model in ESG risks. We would rather do it that way and influence businesses than divest, which is the way that ESG tended to be in the past. We think if you can talk to management about what their plans are to actively manage material risks, that's a better way. You look at a Lafarge-Holcim, they make cement. There's nothing you can do about cement in emitting carbon dioxide, but they're investing in new technologies to capture that carbon dioxide. They actually have gold-plated plants in the emerging markets that actually reduce emissions way more than maybe a China producer would. We'd rather have those assets in the hands of Lafarge-Holcim than maybe selling those off into a different place that wouldn't be quite as good a citizen on the environmental side. So, you know, we kind of have to weigh those pros and cons of ESG, and we talk to management about that.
And do you feel that because this is my typical view about me as a value investor when I do it because of that, is that I own a business for a really long term because I really like the business. Do you feel managers and CEOs and CFOs, as you said, because you have access, they really listen to you because they recognize you as a partner to the business and not as just someone who wants to profit with the trade? Is that important in bringing the hidden value of value to the table?
A great term. I'm going to use that sometime. I do believe for one instance, David Harrow, who's the portfolio manager of the Global Equity Fund, was invited to Stuttgart, Germany to meet with the top 100 managers of Mercedes, Daimler. And the title of the presentation was Sustainable Investing, and how would you run your business essentially in a sustainable way. And he talked about preserving that free cash flow stream over time by making products that are going to be demanded but are sustainable and responsible. And so these are things that we're asked to speak to the board and to the top managers, and they do take in our thoughts there. At times we have to write letters though to the board, or we have to go public into the press and try to change their behavior as well. So proxy voting is things that we do as well. So many tools to try to make sure that essentially shareholder value, we're investing on your behalf. We need to protect your interests. We want that shareholder value to grow over time.
Perfect. And regarding the value image that people have is that people always invest in the same type of companies, and then they are a bit stuck in that. Do you said you are there since 2012. Do you see the type of industries that you are focused on, they change with time, or you tend to, this market division between growth and value is really a hard border and it's hard to cross it sometimes?
Yeah, it's a great point. What we end up doing is doing the same techniques and applying them to different types of businesses over time. So we were founded in 1948, essentially, with our founder, and then ran business outside for investors in 1976 using that margin of safety definition. And in the 1980s, we bought cable companies, and we used price to subscriber to try to figure out what's the value of that business, because they never put out earnings. And so they had a high PE. Why would a value manager own a high PE cable business? Well, we knew that they were adding value by investing in their networks and keeping their subscribers. Today, we can apply that to YouTube, which is a division of Alphabet, which is viewed as a FANG growth stock. But we can basically use our techniques that we've always used and apply them to new businesses. And it turns out that we're having to apply those techniques to more businesses today, because most of their value is in intangibles. And so the old screening way of value investing is not applicable as much today if you're just screening for low PE or low price to book. And so you have to adjust and Fortunately, we have more of a private equity approach to our investing. We do deep due diligence. We're valuing each division. We're speaking to the upper management of the business and really trying to get to know the competitors, the suppliers, and what's going to happen going forward. So to kick off your original point, long-termism is something that we think is our greatest advantage because we're not traders. We're owning these businesses for the long term, and that's where the discrepancy is. It's the holding period between retail and other investors and ourselves as long-term investors.
Thank you, Danny. I think our time is going up, but I must say you made excellent points in defending not only investing in value, but also why do we need fund managers and professional people along with taking the hand of retail investors and trying to make the difference for this ETF approach that nowadays everybody feels comfortable with. But I think they can generate traps because people are just investing in like blind. They are investing with no criteria. It's just buying the market, and the market changes because of that. The heavy companies get more heavy in the indexes, and so I think this is a very good argument as well as for asset manager industry to use. As you said, we investigate the companies, we investigate the trends, and we try to keep the noise, the market noise, away from our decisions. And I think, at least for me, this is very important. And I feel in your speech that you are really certain of what you do, and this is very appeasing for my conscience. It's not only me. So I think it's very important because sometimes it's hard. The hardest worker in this industry may not have the best of lucks, and one guy shooting darts to a screen maybe makes more money in one of the years. But I think this long-term approach is very needed in the market, and I think it's a very good match with value investing. Thank you for your time and for your remarks, and I hope you have enjoyed as much as I do.
I sure did. It was my pleasure. So nice to meet you, and I look forward to doing this in person next time.
Yeah, hope you can come to Lisbon and I can visit you as well. We will change in 6 months. Thank you very much.
Thanks, Nuno.
Thanks to everybody, and see you again when the FundsPeople invite us.